How does shadow banking create market shocks and crises? Imagine a financial world where some players operate in the shadows, outside the reach of regular rules. This hidden side of finance is called the shadow banking system. It includes entities like money market funds, investment conduits, and other non-bank financial institutions. They perform functions similar to banks, such as lending money and transforming short-term funds into long-term investments. But because they are outside the traditional banking system, they lack the safety nets like central bank support or deposit insurance. One big problem is that shadow banks often borrow short-term money to fund long-term projects. This is called maturity transformation. If investors suddenly decide to pull out their money, these shadow banks can face a quick cash shortage. Without access to emergency support from the central bank, they might be forced to sell assets at low prices to cover withdrawals. This can cause prices to fall sharply and spread panic across markets. Another issue is that shadow banking entities tend to use high levels of leverage. Borrowing more money to increase potential returns also increases risk. If investments lose value, these highly leveraged institutions can quickly become insolvent. Their interconnectedness with other financial players makes the situation worse. When one shadow bank faces trouble, it can trigger a chain reaction, affecting many others and even traditional banks. Opacity is another concern. Since shadow banking activities are less transparent, investors and regulators often do not fully understand the risks involved. This lack of clarity can lead to excessive risk-taking, building up vulnerabilities that are hidden until a shock hits. When confidence drops, investors may withdraw funds en masse, causing a sudden credit crunch. Businesses and consumers then find it harder to get loans, which can slow down the economy. Looking back at history, the growth of shadow banking really took off from the 1970s. Financial innovations and regulatory changes allowed these entities to expand rapidly. By the time of the 2007-2008 global financial crisis, shadow banking had grown large enough to threaten the entire system. During the crisis, the withdrawal of funding from shadow banks worsened market turmoil because they could not rely on central bank support like traditional banks. In summary, shadow banking creates market shocks and crises because it operates outside normal rules, taking on risky functions like maturity transformation and leverage. Its lack of safety nets, combined with complex connections and hidden risks, makes it a source of instability. When trouble begins, it can spread quickly and cause widespread financial disruptions. Understanding this part of financial history helps us see how modern economies are shaped by both traditional banks and these shadowy players.